Really excited to be moderating this panel. I'll do a quick introduction. I'm Darren Marbles, CEO of CrowdFundX. I run a crowdfunding agency down south in Santa Monica, California. And what I'd like to do is have each of our panelists do a quick 30-second introduction, and then we'll dive right into the panel itself, which is accessing new crowds, audiences. We'll talk about some case studies and strategies for success. So to lead it off, Georgia Quinn, take it away.
Hi there. Thanks, Darren. My name is Georgia Quinn. I feel like I've heard my name like 20 times already today, so you probably already know. Oh, pull it close. Good?
Yep.
Okay. So anyway, Georgia Quinn, I am a securities attorney by trade, but I have jumped ship, and I am now the co-founder and CEO of a legal technology company called iDisclose. And as Doug mentioned earlier, we help prepare the legal disclosure documents to conduct a crowdfunding. We've automated the process, so it's very similar to TurboTax, to help entrepreneurs be empowered to prepare their own documents at a fraction of the time and cost. But in addition to that, I write and speak extensively on crowdfunding, and I'm still a practicing attorney at the end of the day with Ellenoff, Grossman, and Scholl. So I hope to just utilize that expertise and answer any questions after this to help empower you guys to further this industry.
Thank you, Georgia. Next, we have Ron Miller.
Thank you, Darren. My name is Ron Miller, and first, it's an honor and privilege to be here. Darren, thank you for putting together the panel. Sydney, thanks for putting together such a great conference. I currently serve as CEO of Start Engine, and our mission is to help entrepreneurs achieve their dreams. After having, I'm a serial startup entrepreneur by background, and after having started and raised capital in just about every form that you can imagine, I realized that the ability to raise capital to start or grow a company is the greatest inhibitor to bringing new innovations and companies into the market. And so when I learned about the Jobs Act and saw the opportunity for this game changer in terms of creating the ability to raise capital, I got very excited, and together with my partner Howard Marks have launched Start Engine, which is now one of the leading platforms in the Regulation A+ space, and we'll be launching our Title III platform on May 16th.
Thank you, Ron. And Josef.
Hi, my name is Josef Holm. I'm a tech entrepreneur of about 20 years. I got into crowdfunding about 3.5 years ago. But one of the things that I learned very quickly was that the biggest challenge for most crowdfunders is to build and reach a targeted audience that actually helps them fund their project. So I went ahead and founded Crowdster, which is a crowdfunding marketing platform used by thousands of crowdfunders, crowdfunding consultants, and increasingly also platforms to build crowds on social media, to do press releases, and to help entrepreneurs to reach the right investors for their campaigns.
Thank you, Josef. And Dan.
Hi, my name is Dan Baird. I'm the CEO of Crack the Crowd. Like many of the people on this panel, I was lucky enough to get into entrepreneurship young and found very quickly the pains in not having access to capital. I was talking to someone earlier and mentioning, we started our first company off a $3,000 credit card debt, and I remember about a year later looking at an $89,000 credit card bill and realizing, at the time, this was only even like 2002, this was not that long ago, but access to capital was a huge hindrance, and when I saw crowdfunding, I just realized that entire logistical chain of, you can pay 200 grand on surveys and everything else. You cannot test for whether or not someone actually wants to buy your product. Crowdfunding came up with that solution in a manner that basically cost you near nothing. And when I saw that, it was absolutely fascinating to me. Had a background in marketing innovation and strategy with some big companies and some small companies. So I've seen the bootstrap side and worked at ConAgra to see what you do when you have more money than God. And have combined kind of the learnings from both those to help crowdfunders and crowdfunding technology. So at Crack the Crowd, we help bring people to their audience and do segmentation and targeting, positioning, branding, and help people launch platforms, campaigns, and tech.
Thank you, Dan. Ladies and gentlemen, let's give it up for the expert panel. Come on. All right. So we're coming off a couple very exciting days and weeks here. And Ron, I want to start with you. Elio Motors is an automotive startup based in Phoenix, Arizona. They're the first company in the United States to have closed a Reg A equity round. They raised $17 million from more than 6,000 investors around the world, subsequently listed on the OTC markets, even achieved $1 billion valuation. Now they're trading at about $24 a share, gives them a $600 million market cap. So I'm going to ask you a little bit of a loaded question. How did they do it?
Well, Darren, definitely that is loaded. There were several key aspects of how they actually succeeded in doing it. First is that this was a company that I would say, compared to many companies, was relatively well suited for a major crowdfunding campaign. This was a company that already had somewhat of a following to it. People were very excited about this particular three-wheeled vehicle that was capable of delivering 84 miles to the gallon using gasoline, and also retails for a price of $6,800. So it's the lowest cost vehicle ever produced. And so there's a great degree of excitement around the car even prior to beginning the campaign. So certainly there was something there. There was certainly innovation. But I think that what made the difference was the fact that the founder is an interesting guy. He was someone who's learned from the feedback that he's gotten largely from attempting to raise capital unsuccessfully. I one time asked him, I said, Paul, how did you learn about all of the things that you needed to do and say to get this right? And he said, well, the answer is that I've learned from having to answer the hard questions from so many prospective investors that I took those questions to heart and I adapted them. So what that meant is that when we first met him, we explained that while he does have pretty substantial market momentum with regard to validation of people's interest in purchasing the vehicle, that it really is different. The way that you present in selling a product and the way that you present in selling an investment opportunity, there are some similarities, but there's some radical differences. And so because of that, and because he didn't have experience at that, and because frankly neither did we, I mean, I had a little crowdfunding experience, but nothing much to speak of. And it was at that point that he had indicated that he wanted to hire a third-party agency. And that's when he hired Darren Marble's firm called CrowdFund X. And since that time, what I've learned is that the do-it-yourselfers, and I've seen several come up on our platform that are very well-intended. They think they know what they're doing. Entrepreneurs by their nature are very strong-headed, right? And so they know exactly how to do this. It's like, yeah, I know that I could tune up my car if I wanted to. I know I could do that. I'm a smart guy. I'll go to the library. I'll get the book. I'll figure it out, and I'll make it happen. Well, great attitude, but the reality of that car running well when I get done with this is not very good. And so one of the things that I came to learn to respect is the value of an outside agency that has specific expertise in developing and executing crowdfunding campaigns. At this stage in the development of the crowdfunding industry is not for it's not for the feeble, it's not for people that are learning, but rather it takes professionals to get it done. So let me explain what that meant. In the Elio campaign, fortunately, Paul was open enough, because he had learned the hard way from so many VC and angel pitches, that he was willing to listen. And so when he came in, he wanted to make his video about the car and about the company. But it was Darren and his team that pressed upon him, and of course, Darren and I work pretty closely together, and so when Darren told me, hey, we got to convince Paul of this, we worked together to convince him that the real message behind this campaign was about the revival of the American dream. But not the American dream of 100 or 50 years ago, but the American dream of now. And that is what got people excited about becoming a part of this company and going on the entrepreneurial journey along with Paul Elio in becoming early stage investors in this company. So he was willing to listen and shift that message away from the car, away from the company. Now don't get me wrong, if you watch the video or look at the campaign, you'll see the car and the company are mentioned, of course. But the main emphasis really was two things. One, about revival of the American dream, and second, it was about together we can alter the course of transportation. And so what I've learned about that in terms of what it takes to succeed is that it's not about making a few rich guys richer, but rather this is about all of us doing this together, whatever that happens to be. So regardless of what your company is or your particular industry, really it's more about how we together are going to do this. Now what's interesting is that even though the Elio demographic skews older, white male, conservative, 55, that's who those people are. They're early automotive people, largely, is who's made up the bulk of that investor base. That that idea of us doing it together is really much more millennial oriented. That has become culturally more significant, and as advertising and traditional media becomes more expensive and less effective, then social becomes king. And that's where about us doing it together takes place. So it wasn't just the video that Paul listened to, but also the next step was really a well-engineered launch event. And I got to tell you, in all my years, I don't think I've ever seen anything as creative as this. So what Darren and his team came up with was the idea of identifying the top automotive bloggers and top YouTube stars that had very, very large-scale audiences. And so they flew them out at the company's expense, didn't pay them to produce the content, but flew them out. They got a chance to actually test drive the prototype vehicle and to meet the founder, Paul Elio. They filmed themselves doing this or recorded themselves otherwise. And then what happened is literally on the day the campaign launched, there was in excess of 2 million social media hits day one, right? That's why I don't try to tune up my car myself, because I never would have even thought of that. And like many of the founders I talked to, this is where I try to convince them they need to defer to the experts. Following the social media hit, social media campaign, onward immediately went the PR campaign. And because there was the expertise, Darren and his team, and he's literally, when I say his team, I mean there's a team of people that just deal in traditional PR and media. And what they did was they reached out to the press, and I think over the course of the next 2 or 3 weeks, there were some 60 or 80 articles that were covered in everything from Inc., Yahoo Finance, Fortune, Forbes, Wall Street Journal. I mean, the list just went on of major media, all of which drove traffic to the Start Engine site. And because, again, the site and the content on the site was pretty well designed to convert the visitors to actually, at that point, indicate people that were indicating reservations or non-binding indications of interest under Reg A+. It's one way a company can begin their campaign. Paul got over 47 million of non-binding indication from, I think there were about 12,700 unique people that had indicated interest. Ultimately, by the way, that turned into about 17 million and of actual investment, 16.92 from about 6,500 people. So about half the people, but only a third of the money. So a lot of the big guys dropped out. There were people that were probably just popping in numbers. Hey, I'm in for a $500,000 or I'm in for $1 million. And the big numbers were the ones that dropped out. But the small supporters, the average investment in that campaign was about $2,800, $2,825 basically, was the average investor in each of them. And the overall conversion rate from non-binding to the actual cash investment was about 32% or something like that, 32, 33 of the dollars, but again, 50% of the total investors. And we're seeing similar stuff like that with a couple other campaigns on there as well. So again, I think the second step was the traditional media, the traditional PR, and then the third and final step was the paid media campaign. And really in working together with Darren, this was the first campaign that went live also on Start Engine, and we figured out a series of tracking pixels that we could empower Darren and his team with. We collaborated on building this tracking software so that as the paid media was spent, it was largely on Facebook, but there were some other things that went on as well. It then it allowed us to track very specifically the ROI that the Elio folks were spending on those advertisements relative to the dollars that were coming in. So it was sort of a combination of all that worked. There were some things that we kind of learned and accidentally sort of found out as well. One of the things that happened at the early stage, and Doug would appreciate, George would appreciate, the other attorneys in the room. So I talked to Paul and I said, "Hey, Paul, who's going to be the SEC attorney that you're going to use?" And there's this long silence on the other side of the phone. He says, "Well, let me tell you, I've got my brother-in-law has this law firm in Denver." I thought, Denver? I don't think that, if I want to get an oil and gas lawyer, I don't think I'd go to New York or Washington. But, I was expecting this to, not go well. Turns out it was a very highly qualified, real deal SEC lawyer that did a great job. Very, very conservative, which I appreciate a lot. Meaning that at the early stages, there's a lot of eyeballs on this thing, and we want to make sure that we did it right. And we were fortunate that Paul had a great lawyer who was very conservative on this, and actually over-conservative in saying that initially they thought we could not publish the initial indication of interest, the results. So we couldn't show people on the website how many people had invested or what the dollars were. Turns out she later retracted that, changed her mind, said, "Yep, you can do it." And as soon as we showed it, we got about an $8 or $9 million bump just as a result of showing that. So we've learned some things by accident, I guess is what I'm saying. We couldn't have predicted it. So
Thank you, Ron. Great answer. And just a couple data points. So to give credit to Paul and the Elio team, they came into this Reg A campaign with 40,000 people who would put a deposit down against a vehicle in the hopes they'll one day get one. They had 40,000 additional newsletter subscribers, so they had 80,000 emails, 250,000 Facebook fans. This was prior to doing their Reg A equity crowdfunding campaign. Of the 17 million raised, about 65% of that came from Elio's in-house customer list. A huge percent of the people that had put a deposit down in a vehicle, of course, their customers became investors. Last data point, the Start Engine campaign page for Elio was viewed about 650,000 times. It's an enormous amount of traffic that resulted in 6,500 investors. That's a 1% conversion rate. For every 100 page views that campaign generated, one person invested. I think that's high. So let's transition, and maybe one more note on Elio. They had this massive audience, so this is open to the panel. In terms of the types of companies that are going to be good fits for Reg A or Title III crowdfunding, how important is it that these issuers have the crowd before they do a campaign? What do you guys think?
Well, can I jump in here?
Sure.
I think it's going to be interesting to see. I mean, when we just think 3 or 4 years back, when someone did a press release and said, I'm running a Kickstarter, that was enough to get press. It was just newsworthy, and that's no longer the case. And I think that equity crowdfunding will see something similar happening. I mean, first of all, you did a great job. You're a real trailblazer in equity crowdfunding and Reg A Plus. However, I think in the future, maybe journalists will not be as open to write about something because it's just not as new anymore. So to Darren's point, I think it's extremely important and will become even more important in the future for issuers or rewards-based crowdfunders to build their audience beforehand, to invest a lot of time in it, and to really make sure that they have an in-house audience or someone they can promote this to, especially to get a campaign to the first 30 or 40% when it looks like a success, and you have a better chance of getting outside, outside investors and journalists to actually talk about it and back it.
Dan, what do you think?
I would echo the sentiment. I mean, this methodology and stuff has actually been around for a really long time. I mean, if you hear and have read the book Crossing the Chasm, that early adopter and what do we have? The innovators up at the very front, and then we have those early adopters, and then we transfer through each of these stages. These are the bloggers, the press. They have access to the general audience. For us, I get really excited because it means that just in general, marketing is getting substantially more savvy. By oftentimes compressing these into such small time windows, it really means that you have to do your research up front. You need that audience. You're paying for it one way or the other. It's sweat equity, it's relationships, or you can go do large paid campaigns. But unfortunately, I mean, one of the biggest problems I'm sure all of you always see is someone launching a campaign and then wondering why no one shows up. I mean, it couldn't be more common. People call us halfway through the campaign, they've not even raised 20%, they're wondering how to salvage it, and oftentimes you got to have some really deep pockets, because reviving one of these things is probably 4x the cost of doing it right the first time. So I would absolutely echo the sentiment of, this is a skill. Like, even inside of digital marketing, you will talk to firms and they'll think that they can apply the old model that they have done before to crowdfunding, and it does not work that way. You don't have 90 days to optimize your campaign. You have to start and you have to be running as you hit the ground. For that reason, I think for us, in kind of the agency space, it means that we actually really have to be on it. I mean, it's really sophisticated. The lists and the project management that goes into these raises is actually really hard. Hundreds and hundreds of lines long. It absolutely gives our clients headaches just to even look at them in the first place. But for us, it means that targeting these investors and getting really, really good at segmentation on, okay, well, as you guys, we're going to start, or even last year, we saw a lot of the investments, everyone was just throwing around their ROI and their IRR. That's already a little bit old. People are moving into more emotional appeals and hedonic appeals, so the IRR is there, that's the hurdle. But now we're getting into much more sophisticated, if you will, kind of long tail positioning of, yes, it's that real estate investment that you're looking for, but it's green or it's local. For that reason, you combine general solicitation, the fact that all of these raises are now publicly available, combine that with the fact that we have better targeting, and I think in general we're actually probably going to see better businesses as a result. I'm actually really excited for this. I think we're going to see more, bigger, better innovation in a shorter period of time. So.
Thank you. So Joseph and Dan, Georgia.
Yeah, I just wanted to add a quick point to that. So yes, there is no free money. It is going to require work. And I think, as far as industry types, that was part of the question, what types of companies are better suited for this type of financing. Obviously, consumer-facing companies that have a large retail base or, a passionate, devout following. But I just want to make a quick point because we've been talking about this Elio campaign, and it was fantastic, wildly successful, done in the proper way. But this is a huge scale. I mean, you just heard them talk through, a huge, multimedia sort of campaign. But remember, there are many different types of crowdfunding that are available. So when we're talking about a Title III crowdfunding campaign, that the maximum amount that issuer can raise is only going to be $1 million. So to do some kind of full-blown mass marketing campaign, that's probably not going to be feasible. So there are other ways and other alternatives, and Dan kind of touched upon it in some of the online marketing strategies that are available and out there. And so, just keep in mind the scaling ability of crowdfunding, and it doesn't always have to be this full-blown, beautiful, glossy, shiny campaign. There are other ways where you can reach your customer base and target them on a real, fundamental personal level that will go a long way and be very meaningful.
That's a great point. So let's talk about the range of scale here. You've got an issuer that's looking to raise, let's say, $1 million under Title III come May, June. What are some steps that these issuers can take now to build their audience, authentic, engaged customers, fans? What are the couple activities that these issuers can do now that might be low cost or no cost to set them up for success down the road?
May I?
Sure.
Go ahead.
Listen. We kind of created a product just for this called the Listening Post, and it's essentially where you go out into your digital space and you basically use social platforms as prospecting environments. You set up LinkedIn alerts based on LinkedIn groups, and you get notified. If someone is in your space, you're listening, you get notified, you respond publicly to make sure that people know who you are. We set up, using Crowdster, influencer lists to actually track who the people in the space that are really worth connecting to. So in the beginning of the relationship, you retweet, you like their tweets and things like that. Later, you start interacting with them. After that, you may start asking them to interact and actually contribute to content that you are creating, and this helps basically build your influence. You can turn on and go to Quora, LinkedIn groups. We have Twitter lists that you can set up. I mean, all of these are spaces where basically you can have this media that's out there, but you don't have to go and seek it out. You can actually have it come to your inbox. Reddit is a fantastic place to go and see what at the very tip of the spear is taking place right now and how the market is reacting. But listening and watching and then beginning to introduce yourself is a really great way to establish that influence. The more you interact, the more you co-promote, and the more really, it really is incredibly important to, it's not about you, it's about us. It's about what we can build together. If you come in with the idea of, let me show you something that I've made that's phenomenally cool, it will fall on deaf ears. And in the internet, oftentimes it'll backfire on you. Yeah, those were probably the main few. I'm trying to think. If I think of any others in a second, but that's where
Joseph, any feedback to add?
You've covered pretty much everything. I think the most important part here is that people need to realize that if you don't have a crowd already, you don't have a 250,000 email list like Elio, and most people don't have that. You're starting from scratch, and building a crowd does not mean hitting people up on Twitter asking them for money. It means finding the right people, identifying your target audience, engaging with them, actually bringing something to the table that interests them so these people follow you back. That's a process that can, takes months, maybe even years. It depends on, where you are at, how much you want to raise. But, many people think that, especially in the reward space, that they just, you launch a campaign on Kickstarter and then strangers come and throw money at you. And unfortunately, that's true. We wouldn't be sitting here, right? We would just launch campaigns all day long. It doesn't work like that. At Crowdster, we have built a lot of tools that people can use because we know that the majority of campaigns don't raise enough money to afford professionals to help them. So the tools that we have created are self-service tools that they can use to build a targeted Twitter audience, to find influencers, to do content research, to find out what kind of content does really well and what kind of platforms and how can I, reach out to that author or, post a comment and drive traffic like that. There are so many different layers to it, and the most important thing is really to take the time before you launch and make a plan, like Dan said.
Thank you. So Ron put out a great article this morning in CrowdFund Beat. I don't know if any of you saw it. It was about equity crowdfunding and venture capital coexisting, and Ron brought up the top 3 concerns that VCs have about equity crowdfunding, and they're all related, each of those 3 concerns, to unaccredited investors and the number of investors in a cap table. So Georgia, I want to ask you a question. We just said that Elio, that campaign resulted in 6,500 retail investors, the majority of whom are unaccredited. So what types of precautions do both issuers and platforms need to take as they're thinking about marketing, taking in hundreds, if not thousands, of unaccredited investors into their businesses?
Yeah, I mean, it's a very important consideration that needs to be well thought out and planned long before you launch the campaign. It depends on what type of crowdfunding offering you're doing, whether it's Title II, III, or IV. But certain, legal structuring, precautions that you can take are to create an SPV where you will house all of the crowdfunding investors, and then that SPV can invest as one line on the cap table of the company. You can then set up an investor relations, whether it's an online interface or have a traditional investor relations company help you manage those investors. But whatever it is, you need to put something in place. Now, unfortunately, with Title III, that's the retail crowdfunding, with the cap of $1 million, we're not allowed to use the SPV structure. So again, it's going to have to be some sort of online service offering, or again, even just the traditional, telephone investor relations type of service. But definitely you're going to have to think about how you manage those investors, how you communicate with them, because they do deserve the full and fair information of your company on an ongoing basis. And I think probably the most important thing to do is to set expectations at the beginning. If you tell your investors that they can expect, an annual report on this day telling them, all of the new and updated information about your company and its performance, that you're going to have a video chat on this day, whatever it is, up front, that will set the stage. But if you don't have a clear, articulated disclosure policy with your investors, then you will get those random phone calls all the time. Why don't I know, can I talk to the CEO? Can I have, financial statements? And that's just going to be a nightmare for you. So all of those procedures need to be put in play long before you actually launch the campaign. And they also need to be disclosed early to those potential investors.
Thank you. So we're going to do one more question, and then we're going to open it up for maybe 5 minutes of audience Q&A. So if I could have each of the panelists address this in maybe 30 seconds. We've seen that in the rewards-based space, the majority of campaigns fail. Majority of Kickstarter, Indiegogo campaigns do not succeed. And in fact, the ones that do succeed, the average raise is less than $10,000. So I believe we're going to see a similar phenomenon here in the equity space, in that most issuers who launch equity campaigns will fail. So maybe starting with Dan, why do you think crowdfunding campaigns do fail, and what's one piece of advice that an issuer can think about to maybe prevent that from happening to their company or their campaign?
I'll start on that one. The lack of preparation is often it. A slightly different point of view, I actually don't know that we'll see the same failure rates that we actually see in the reward space, just because there is no regulation largely regarding the reward space. Like in a lot of the technology that you currently see, they'll actually incentivize you to just put up a campaign really, really quickly. It's a big part of their UX. Now, the really good campaigns that do really big dollars are absolutely going, with months and months of preparation. But because the equity raises, they require everything from the I disclose, the PPM arrangements and lawyers and everything else. I think they'll be getting much more of a reality check prior to actually launching. So I think for that reason, they'll probably be a little bit more prepared. Even though it's in many ways less expensive, I think they'll know a little bit more about what they're walking into. So for that, for that reason, I think we'll see lower failures. But on top of that, I think that preparation that will come from, you guys know this. If you go into a crowdfunding equity raise, it's not like you can make one call. Actually, it's good for me because I get a lot of calls because I have to make calls on other people's behalf. But I think they'll be more prepared, and that preparation will lend to better,
Excellent.
bigger raises.
Preparation's key. Joseph, what's your thought?
You're stealing all my good talking points. That's my thought. I think it will be very interesting. I mean, to Dan's point, you can go on Indiegogo and launch a campaign in 2 minutes, and that probably explains their 92% failure rate. You got to think about that. 92% of people who launch a campaign on Indiegogo don't reach their goal. So a lot of that has to do, again, with lack of preparation. But what's interesting, I mean, Title III is again completely different, in my opinion, from Regulation A+. From Title II, where you deal with accredited investors, where a platform may have a database of investors, but if it's Title III, you're really talking to the same people who would also invest in a rewards campaign on Kickstarter, because most of these people aren't investors. They're not savvy professional investors who think like, oh, my $5,000 is going to put my kids through college. That's just not going to happen. They love the idea, they love the story that's being told, and they want to get behind the product that appeals to them. So I think again, it's all about preparation and reaching the right people, and having a story that's compelling.
Excellent. Ron?
I read recently a line that I've taken to heart, which is that the quality of your life is directly dependent on the quality of questions that you ask. So now I'm going to adapt that, and I'm going to say that the success of your campaign will also be determined based on the quality of questions you ask. So where people run into problems, I think, is, it sort of looks like this, and you have to excuse my gesture here, but I'm going to do it, which goes like this. I know. Right? And we stop listening, and we know. So I talked to a guy the other day, wanted to launch a campaign. I said, how much are you interested in raising? He says, $30 million. I said, that's interesting. And I said, tell me about your target market. He says, well, I've got this musician who is got an audience of, is a DJ that has an audience of indie rock and indie reggae music. I thought, 30 million. Okay, so what I would have thought would have taken place, I mean, he's basically showed me he hadn't done his homework. He hadn't looked and figured out what campaigns succeed and fail. If I was going to launch on Indiegogo, I would look and I'd say, show me the 8% that worked.
We actually have a tool that makes that very easy.
There we go. I didn't even realize. See? That's why he keeps me on the payroll. But I would look to see what worked, and if it was me, I'd probably pick up the phone and I would call the people that successfully ran those campaigns and say, tell me more about this. And I'd start asking questions, a lot of questions around what worked, what didn't work, what did you actually do to prepare, what didn't you do that you wish you had done. Certainly, although I saw the Coolest Cooler story this morning, very, very sad about they ran out of money with their reward campaign. But basically, these are guys who tried to launch a campaign and failed, and came back the second time and got 13.2 million or something like this on a Kickstarter campaign. They learned something from that first time around, and if it was me, I wouldn't let go of them. They'd be getting emails and phone calls from me until they figured that it was easier to talk to me than not. So I would do my homework first.
Excellent. Preparation, ask questions, do your due diligence. And Georgia?
Yes, so I too agree that the success rate for Title III crowdfunding will be much higher than what we see in the reward space. And it's for a similar but little different twist on what we've heard before, which is there is a very intense screening process. So you cannot just go and slap up a deal on any website and expect to raise money. In the Title III world, first of all, the portal is a registered portal with both the SEC and FINRA. So they have obligations and requirements to screen and vet the companies that will be listing on their platform. In addition, the Form C that we mentioned is a legal disclosure document that also has to be filed with the Securities and Exchange Commission. So if you get a company that's serious enough to go through the process of finding a platform and making it through the screening procedures of that platform and then preparing that Form C and filing that with the SEC, you're already dealing with a company that's serious about this, that has their ducks in a row and is ready to launch a hopefully successful campaign.
Excellent. Thank you to the panel. So we'll open it up for maybe 10 minutes of Q&A. Yes?
Hello. Hi, Bill Sauter with Galaxy Ventures. Question is primarily for Ron, but any of you, if you want to chime in. I'm curious if you have web analytics on the investor decision-making process? How much of it is an impulse buy versus they're doing due diligence, downloading company documents, perusing pro formas, things like that, before they actually make the decision to commit?
Yeah, at this time, we do not have those kinds of analytics. We wish we did, but the reality is that in launching this platform, what happened is that the SEC, I think it was in mid-March, voted the final rules, or voted to approve the final rules for Reg A+, and only gave us about 90 days. And at that point, we had thought Title III was coming out first, so we had to launch that platform pretty quickly, and it had to be reliable. And there were some things that we did that I tell our product people and programmers, don't ever try this again in your career, just because of the scale that we were launching at was pretty substantial, and if it didn't work, it was going to be huge. So we did not do the development work that would get to that stage, but it is in our development queue because we know that it's highly valuable to our issuers who are looking to use those analytics to make better decisions about how to operate their campaigns, as well as to help us in advising the next guys on what they can do to optimize the results of the campaign.
I'll add some quick feedback. I think 80% of the decision that a retail investor makes to invest in an issuer's campaign is based on alignment of vision, mission, and values with the retail investor's worldview. So I think investors want to make money inherently, but the issuer's story needs to be told in a way that's going to elicit a strong emotional response. And that was the strategy we took with Elio, which is that people don't care about what you do, they care about why you do it. And therefore, the story needs to be really compelling and almost needs to transcend the product or service itself. Next question. Yes, right here.
Hi, my name is Reggie Richter. This question may be best for the lawyer, but anyone is
Oh, boy.
happy to have anyone answer. But my question is, with the equity crowdfunding, is it's easy to get into these investments, but of course, the first thing you want to look at is how do I make money, and that means you've got to exit in a reasonable time period in order to get a return. Do you think that this is viable without some form of secondary market being developed for the trading of these shares, and how do you think that'll work itself out over the next few years as this develops?
Yes, so I think that's a great question, and it is a long-term investment. When people make this initial investment, they have to go in with an understanding that this is an illiquid security and that it has a longer time horizon, and they have to be ready to accept that. That being said, I do foresee a secondary market arising because these securities do become freely tradable after 12 months. And so there's an issue now as to exactly from a regulatory perspective how that would work, but I have absolutely no doubt that a secondary market will develop.
Ron, do you have any comment on that after seeing Elio list on the OTC? And I know that Reg A and Title III are slightly different, but what's your take?
Yeah, so it is a great question, and as a platform, we're very interested in the value proposition to the investor being one that makes sense, which means if I invest, well, how do I get my money back, and how do I make money? Well, in the Elio case, what I had read, Cromwell Coulson, the CEO of the OTC Markets Group, had made many favorable statements in support of Regulation A+, and had indicated their interest in providing that secondary market for these shares. Now, I've come to learn that will probably work on some of the larger issuances, for companies that perhaps are issuing more than 3,000, maybe even more than 5,000 unique investors, with probably in excess of 10 million. I don't know if it's going to work for smaller ones than that. But it did work very well in the Elio case, so he went literally from the Reg A+, he just closed the round, I think, and within a week, he had listed on the OTC, and the share price that was originally at $12 went initially, literally within the day, up to 20, and it went as high as 60, and it's since dropped back to 24. So if you were an Elio investor, you had a shot at a 5X on your money, but today, I think it closed yesterday at 24, so you could still have a 2X on it. So there is some liquidity. We at Start Engine are going to develop that capability on our platform for companies that have raised money on our platform. We intend to provide that secondary market as well. And then finally, I would just mention, I saw I think yesterday there was some action in the House Financial Services Committee to create some legislation around the venture exchanges that I haven't yet looked at. But there's stuff happening there for sure.
Can I add a little bit to that? This is I am not the regulatory person on this panel, but one of the other challenges with the secondary market question is Anecdotally, a lot of the broker-dealers and registered reps will talk about how the retail investor tends to call you after they've already invested. The institutional investor calls you a lot before they invest. Even with the secondary market, one of the big challenges with that, from a non-regulatory perspective, is a knowledge barrier. You can give someone PPMs and things like that, but if you're working with NASDAQ and public markets, there's reviews, there's rating agencies, and there's things like that. There isn't that immediate transfer of knowledge on a secondary market, and these are oftentimes, they may not be well-known companies, especially in a few years when we have a ton of these raises going. So there probably needs to be someone in the audience, ratings agency, big idea, big idea, big idea.
All right, thank you guys. We're out of time. It's been an honor. Thank you to Sydney, CrowdFund Beat. Let's give it up for the panel.